Hi, this is Zak Mir with the best of the bulletin board heroes here at Zak's Traders Cafe for 2023. The main point to note here, most of the stocks were covered here before or during their ascent rather than afterwards, so that's something to remember. Here with Capital Metals, the rise back in September was flagged by the bullish divergence that we had there with the uptrend line from back in July, and then the sideways shuffle above a rising 50-day moving average, one of the best setups that there are. And obviously that came ahead of the license news back in October. Current position is that we're hoping that the market will, or the stock will find support around current levels. That's basically the November support area around 3.5 pence. Obviously the placing's out of the way. If you're cautious, be waiting for a break of the 50-day moving average around 4 pence before assuming that the ascent up to 6.5 or 7 pence will happen early in the new year. Celadon is next, and here the sizzle was back in March with license news again. Once again, the same kind of setup with a break of the 50-day moving average that was rising, and that came ahead of license news that we had during the middle part of March, and the rally subsequently went up towards 180 pence. Since then, there's been a drift, but we had a bear trap gap reversal back in November, and if we can break 120, we could be back on our way to 180 early in the new year. Near-term stop loss is the 50-day moving average around 103. Chill Brands has been one of the more volatile rides of the past year, but we had once again in January the sideways shuffle above a rising 50-day moving average. That happened for a week before the big break back in February, and that rally took us up to nearly 14 pence before the rug was pulled from underneath the bulls. Current position is that we're looking for 6.5 pence to break. Really, that's a resistance line there from back in July, and if we can break that, then it could be back up to 14 pence again early in the new year. Current position is that support is just below 3 pence, and we really want that to hold as well after the pullback from 6.5 pence. Cornerstone is next and seems to have a lot of a knowledgeable Twitterati following here. Here the situation is that basically we've had a sort of steady rise over the course of 2023, 3 steps up, 2 steps back type of thing, but the real sizzle came earlier this month with the unfilled gap to the upside, and then building on that, nice tight bull flag, and then breaking higher as well. Above the 20 pence level, which was the old target here, we're looking for the shares to head up towards the 28 pence level, hopefully in the next few weeks, and obviously after that, looking at 40 or 45 pence for early in the new year. But the key here is holding above 20 pence on Cornerstone. DG Innovate really inspired the market earlier this month with the Tesla connection. Here we hit all our targets. In fact, we exceeded even the best case scenario target there at 0.19. The current situation is that we want to see the shares hold above 0.12, which was one of our previous targets. We're just going into a golden cross, which tends to be the strongest part of the cycle. Obviously, the run-up to that already has been. And the rally started here with an unfilled gap to the upside and then the follow through on that. But it was suspected that the shares would turn around even as low as the 0.04 pence level. So that did work out quite well even before the news came out. Best case now is up towards a line of resistance from way back, actually, back in 2021. That's heading towards 0.4 pence. So hopefully sometime in Q1, we'll see the shares hit that level while we're above that 0.12 level. One of the stocks of the year on both a fundamental and a technical basis has been Empire Metals. And here, I suppose that the latest big push was through back in July through the rising 50-day moving average in the first week of that month. And even though we had a pullback towards the 3.5 pence, and it's been a very strong rally, probably the best you can expect in such a dull year anyway. Current position is that we're hopefully going to find support at the bottom of the old gap there from November. That was around 8.5 pence. Fading that, it would be 7 pence and a previous resistance line target. And while we're above that, looking for best case scenario target up towards 15 pence early in the new year. Moving along to a stock which was rather obscure. I don't think it's so many people talking about it, but IMC, here the classic pattern of a break of the 50-day moving average near the lows, and then a sideways consolidation above that, and then finally the big break higher. And in this situation, we hit not only the first target there around the 2p level, but then up to the second one around 3.1p. Ideally now we'll find support at or above the 50-day moving average at 1.7, and then maybe retest that 3.5p area early in the new year. Moving along to another relatively untalked about stock, which was Intelligent Ultrasound. Here the excitement was the bear trap gap reversal back in April. In fact, it was an island gap reversal, bear trap island reversal, in the sense that we gapped down and then gapped up, and then we had that massive spike. Current position is that we'd like to see the shares remain above the recent falling wedge around 9p, and then head up to 14p for Q1 2023. Bullish divergence there as well, so hopefully IUG can regain its previous magic. McBride was a stock which I didn't cover very much. I think maybe covered it once or twice at the most, but the big move here was the bear trap gap reversal back in October, and then holding the 50-day moving average, rising trend channel there from back in February, and we've just touched the top of that there around the 90p level. The rally started, I suppose, back in February with the break above the 50-day moving average, and then the rally, rising 50-day moving average, and then the rally after that. There was a second chance back in July with a gap through the 50-day line, but similar sort of slow burn type of situation in both entry points. Moving on to Ondo, which certainly has been one of the highlights of the year. Again, a combination of fundamentals and technicals with the unique business model the company has. We had the gap through the 50-day moving average back in April, and although the shares have come back quite a lot from the peak that we had in August at 38p, we're still holding on to that rising trend channel. I'd like to see the shares remain above the recent gap area around 20p, and then hopefully head up towards the low 30s by the end of February. If you're cautious, you wait for a proper clearance of the 50-day moving average around 23p. Orcadian provided quite a spark, especially given the way that I suppose most in the market had given up on the shares back in June, July, when they were around 2p. But farm-in news was the driver, and we had a very strong rally there from around 3p to nearly 30p. Current position is that we're looking for support to come in around the 12p area, which was support back in September, and also that peak back in August. But ideally, there's a clearance of the 50-day line early in the new year to get the shares back on track. Optibiotix again surprised the market. Well, surprised who don't really follow the stock quite a lot, in the sense that we had the aspartame read across, and the sweetener factor was the initial spike that we had back in July. That took the shares up to the low 40s. Current situations, we'd like to see the shares find support above the 20p level, and then head back up again for the new year, maybe up to 35p in Q1. Once again, the 50-day line now at 27p, a decent entry trigger for those who want to see momentum in the shares. A surprise entrance this year was Plexus, but you can see the classic entry point there with the break above the 50-day line near the lows, at the rising 50-day line, then leading to the big move higher. Current situation is that we are consolidating well in recent ranges between 16 and 24p, and obviously looking for a break of 24 over the next few weeks. 50-day line is also rising now, so that means or suggests that we could be ready for another push to the upside relatively soon. Petrel came across in a good way this year. That was a stock which probably previously was not really on the radar, but came onto the radar with a breakout back in the early autumn, breaking through the resistance there from June and September around the 1.65p level. Above that, we managed to creep up to the target around 3.2p, Still consolidating near the highs, which is encouraging, and the best case scenario there, up to 4 pence, maybe over the next 1 to 2 months, if we can hold above 2.5 pence in the meantime. On to the last two. First one is Silver Bullet, which against all odds managed to be one of the best rises of the year and also stay up, which is actually more of an issue in these markets because people just tend to take profits on anything that goes up. But we had unfilled gap to the upside off a rising 50-day moving average, and then the spike came. Currently, the 50-day line is rising around 102, and we're still looking for up to £1.55 over the near term, maybe the end of February, if these shares remain above that 50-day line. One of the highlights of the year, both bad and good, has been Upland with its spoof takeover that it had back in October, but the shares actually regrouped probably rather better than most, including the bears, would have expected. We're above the rising 50-day moving average, and we found support well above that particular feature at 3.2 pence, looking for 5.5 pence, maybe by the end of next month. Big picture target here up to 9 or even 10 pence if we can hold above that 50-day line. That's it for me today. More updates in a normal fashion during the week.